Ever since the Tax Cuts and Jobs Act of 2017 increased the standard deduction, people have been looking for ways to maximize their charitable giving. And one way that they can go about doing this is through clumping different years together through a donor-advised fund. So we're going to talk today about what is a donor-advised fund, how you can utilize one, and how it could be helpful for your financial situation. All right, so Spencer, as we think about donor-advised funds and what people can use them for, tell us just a little bit, what is a donor-advised fund?
Well, you could think about it as a charitable piggy bank of sorts. You put funds in, they have to be earmarked for charitable purposes, and then you can use them over time. So you don't have to use them all at once, but they're, again, parceled out over time. It's a nonprofit institution, but it's also a supporting institution in that it's not going to use the resources directly. Again, it's going to parcel out to these different charitable institutions. And Fidelity Charitable is one of those institutions that offers donor-advised funds, as does National Christian Foundation and many others that are out there.
Okay, so when we think about a donor-advised fund, how does that actually work? What are the things that we have to know about just a general donor-advised fund?
Well, first thing, it's fairly simple to set one up. Oftentimes we have clients who are surprised that it only takes about 5 minutes to set up that donor-advised fund. But basically, we have it and it's named, and it just is a fund that receives resources. This can be cash. You can set this up where it's linked to your bank or credit union account. You just push resources over via electronic funds transfer, or it can receive appreciated securities. And this is part of the tax savings that we can see. But there needs to be a funding mechanism. And then at the donor advised fund, you select a fund to hold it, because it's not usually just in cash. It can be invested over time, whether that be in a bond portfolio or stock portfolio or some mix thereof. And then as we go from there, we see that gifts go out and are parceled from the fund, because you as the donor are the advisor. You no longer hold those funds, but you're the one that tells the donor advised fund where to parcel those resources out. So those are some of the basics as we kind of think about that. Any donor advised fund, they're only going to push resources out to other charitable institutions. They have to be 501c3 charitable institutions or like registration charitable institutions. They couldn't be pushed out to a grandson or granddaughter or different individuals.
Well, and you touched on cash gifts. You can also make stock gifts. You can also even give privately held business interests as well as real estate. So there's really a broad spectrum of things that you can give into a donor advised fund. So one thing we want to make sure that we note is those gifts are irrevocable. You can't say, I'm going to give the $20,000 into a donor advised fund, and then the next day think, oh no, I need that money back because my HVAC system just broke. Once you make the gift is irrevocable. What are some of the key things that we need to know about that irrevocability?
In theory as well, one of the reasons that people need to be careful is that as they make those gifts, they need to be aligned with the latitude that the donor advised fund has in terms of the institutions that they can pass them on to. Some institutions like Fidelity Charitable, they really represent any charitable institution that's out there. There are others that are out there that say, well, no, they have to actually be aligned with our core values for you to use us as a donor advised fund and pass them along. So we need to be careful about that, because it is an irrevocable gift. And it is one that you become the advisor. You cannot hold their feet to the fire and demand that they pass resources on to a particular institution. So that's a little bit different than, say, a private endowment, where you actually still retain more control over those resources while you do it.
Okay, so let's talk about tax deductions. So we started off this video talking about the standard deduction was increased substantially with the Tax Cuts and Jobs Act. So when we think about the deductions, if you need a refresher, we just did a recent video about tax credits and deductions, and you can take a look at that. But when we think about donor advised funds in particular, how does this work to a client's benefit?
Well, you get to choose the timing of the gift and the deduction that's granted there. So you can then parcel the gifts out over a period of time. Let's just say that you have a high income year. You are at the last year of employment, you get a significant bonus, and you realize that it's going to push you up one or more tax brackets. You may say, well, I want to be able to give a significant amount of extra gifts this year, but I don't exactly know where I want to parcel out all those resources. Maybe you've come to December and you just realize, hey, I'd love to be able to knock $30,000 off my tax bill with a very big gift, maybe a six-figure gift, but again, don't know where you want to parcel those resources out. Or you may say, I'd like to do that over 3 or 4 or 5 years. If you give to the donor advised fund, you get the tax deduction up front when you make the gift, and then thereafter you can choose when you ultimately push those resources out and the charities that you do so to.
And we want to make sure that the folks that are listening know there are AGI limits to the amount that you can give. So if you are giving cash, it's up to 60% of your adjusted gross income. Now, if you are giving long-term appreciated securities, it's only up to 30% of the AGI. And so there's also other caveats of, is this a non-for-profit? Is it a private institution that you're giving to? There's all sorts of caveats, but that's by and large, if you're giving cash, it's 60%. If you're giving appreciated stock, it's 30%. And by and large, those Fidelity Charitable, National Christian Foundation, Vanguard Charitable, those are going to be able to receive those at those limitations. So again, work with a tax professional as you're considering these, because you want to make sure that you don't cross that threshold. There's some carry forward that you can still benefit from, but you want to get the most amount of deduction if you're trying to clump multiple years together.
Exactly. Well, and there's other aspects to this that oftentimes clients don't appreciate how much benefit beyond just the tax savings that they may have. So one of these is that oftentimes the entire family can start to have conversations about the gift and even what happens after the grantors die. You want to talk a little bit about that?
Yeah, so at the grantor's death, there's one of a few things that can happen. And either the grantor can say to their beneficiaries, hey, when I pass away, you all will retain control of this donor advised fund, which then allows the next generation to direct those gifts. So it allows a family to have conversations about, where do we want to be charitable in our lifetime? Where do we want to be charitable? Where do you want to be charitable, children and grandchildren? And so it's really a beautiful way to have those legacy planning conversations about, what does it mean to really have a generous legacy? The other piece is, if you do not want your kids or grandkids determining where your funds go, maybe there's a misalignment between you and your kids, you can decide, when I pass away, then resources will go to the charities that I love. And it can either be an immediate distribution, or you can say, over the next 5 years, I want these gifts to be parceled out to these charities.
One of the nice things there too is, rather than naming multiple institutions, say as a beneficiary of your IRA, you can just name one institution as your donor advised fund, and then update your donor advised fund last wishes as soon as you might like to. So that could have 8, 10, 20 different charities, all getting a smaller amount if that's the way that you ultimately want to go. So a lot of flexibility in how you position donor advised fund receiving particularly IRA or 401k proceeds that it will not pay tax on there.
And to that point, Spencer, when you think about, if you have a church or charitable institution that you want to receive resources from your IRA, it's much easier if it's passed to the donor advised fund and then passed to the charity, because if they're named as a beneficiary of your IRA, they have to set up an IRA in their name to then receive the funds to then make the distribution. Again, it still goes to them tax-free, and it's a hurdle that the charity will likely jump through because they want to be able to receive those resources. However, if you name the donor advised fund as that beneficiary, those changes that you make are very simple, both for you, the donor, as well as the recipient of the gift.
Really does simplify things there in a helpful way. The other thing is that it really can help simplify, and that clients all the time will tell us that it has helped simplify their giving on a year-to-year basis. And the reasons are many here. One of them is there's a tracking of what you gave the last year or the year before last, or if you've been doing this for some time, you can see your whole trajectory of giving over time. It will allow you as well, if you have something that comes up and you want to, you're told by someone that, there's an opportunity to make a special gift. Oftentimes we'll have clients that'll just pull up that donor advised fund on their smartphone and be able to make a gift if that's, $100 or $200 or something like that. It really can simplify that process overall. And then the final thing it does is it simplifies year-end work with the CPA, because if you're doing all of your giving through a donor advised fund, you present that CPA just with one tax form rather than collecting it from 20 different charities and presenting it to your CPA, and then they've got to do a line itemization of all of those to be able to figure out the credit that you get there. So it can simplify it on multiple counts. And the final thing too, of course, is that as those resources grow in a donor advised fund, sometimes that allows you to give more in a very simple fashion there as well.
So before we get into cost, we want to touch on just privately held businesses, business interest, as well as real estate. There's a little bit more complexity to both of these. From friends that we know in different donor advised fund spaces, they don't like to hold business interest for long periods of time. Likewise, the IRS doesn't like it when you give a business interest and then sell immediately the next day. So there needs to be some planning here that there is a sale on the horizon, because most donor advised funds don't want to hold that business again for long periods of time. But it can't be so close to where it raises flags with the IRS. So this is where you really have to be careful when you're thinking about giving a business interest into a donor advised fund. Now, when there is a sale of a business on the horizon, we'll look at some examples in a future video, but it can really be beneficial to knock down some of that capital gains tax burden from the sale of your business. But again, you need to work with a CPA, you need to work with that donor advised fund to make sure that you're going through all the right processes to be able to give that gift well.
And really, the trigger point needs to be when you start thinking about selling your privately held business, you start this conversation. If you have a desire to make a significant charitable gift in that same year to knock your tax bill down when you sell your business, start with that conversation initially, even before you look for potential buyers or suitors for the business. It's an important step.
And then likewise with real estate, you can place real estate assets into a donor advised fund. Again, there's complexity here where you share the donor advised fund receives some of the income. But again, that's more complex than we want to touch on today. But we just want to say it is possible to give real estate interest. And if you want more information about that, you can reach out to those donor advised fund institutions and they'd love to have a conversation with you.
And in general, there needs to be a significant gift. Oftentimes it needs to be something like $750,000, $1 million more for these types of different complex assets, because there has to be an appraisal, because there have to be different attorneys that are involved. And so the amount of complexity there, it needs to warrant the focus, that's put towards it.
So let's talk about the cost of a donor advised fund. What are traditional costs for each of these funds?
For most of the funds, there is some baseline nominal level that the fund costs in terms of just holding resources. And that's typically something like $100 on an annual basis. And then as you have resources that are there, if we look at it, it's usually 0.6%. So if you have $50,000 of resources on average in your donor advised fund, 0.6% is $300. So that $300 is more than that baseline level of 100. So they'll charge you $300 in that year. If you only had, let's say, $10,000 in that fund, then the fee would be, for most of these institutions, a minimum of $100 a year. And you may say, okay, well, that's a headwind to me being able to give there. But what we've found is that, again, the simplicity of the process, helping to make it easier and working with your CPA, you're going to make it up for that in terms of the time that you save, both for you and your tax preparer, if you move in this direction 9 times out of 10.
The other piece that we want to touch on there is there's going to be underlying fund expenses. So if you do put the funds into, let's say, a stock fund or a bond fund, there will be some expense there. So just know that going in. It does allow you to invest it, but just like we would say, if your time horizon is short, invest it in short-term resources, because you want to be able to gift those resources and not lose tremendous value. So again, there is a little bit of planning here. Just be wise about when you're making those gifts, how long you want that to be invested for before you start saying, oh, I can get an additional return via a stock fund, I'm going to go there, and then the fund loses some value. It doesn't detract from the gift that you've made, but if the fund loses value, you may not be able to then distribute funds as much as you anticipated. So just be aware of that as you're thinking about a donor advised fund. So that brings us into some of the downsides. What are some of those, Spencer?
Well, we touched on it earlier. You lose control of the asset. There can be loss of value of an investment if you invested and the fund value goes down. And there's ways that we can kind of manage that risk and offset that typically. But the big picture is we don't want to put the cart before the horse here. We don't want to just do a donor advised fund because there are some benefits. We really want to think about how that situates in a client's financial plan in a bad tax year or in a year where we can clump some deductions together. Oftentimes it makes a lot of sense, but it doesn't make sense for everybody. And so we really need to be careful as we think through this as an option.
Okay, so just like you were saying, some important questions to ask. Where does this fit into my financial plan? If you're only doing it because of the simplicity of, I want to open a donor advised fund because I just want one receipt, but you're only giving, let's say, $10,000 a year and you have no other itemized deductions, well, maybe this doesn't fit because yes, you only get one receipt, but you don't need to file the receipt because you're below the standard deduction. So really, it does need to fit in your financial plan. Another question that you may want to ask is, have I talked to my tax professional about this gift or this strategy? They really need to be involved, making sure that there aren't any hiccups to the gift that you give, or making sure that you don't surpass certain thresholds, or again, are you going to get above that standard deduction? Is it going to be helpful? And then the last one we would say is, how can you invite your family into the process? You want to touch on that a little bit more?
Well, and this is really driven by a client's particular situation. So it can be wonderful to invite a family into that conversation, but again, you need to have alignment of values, kind of like what we've talked about. One of the things that we would always suggest is that as you look towards the future, as you do some estate planning, that everyone's on the same page. If you're going to use a donor advised fund to receive some IRA resources, you just want to make sure that your other beneficiaries are aware of that and that they have a general understanding that these resources then will be pushed out to other charitable institutions.
We hope you enjoyed this video about donor advised funds. Stay tuned for our upcoming video where we're going to talk through some scenarios that may be helpful to unpack and understand a little bit more about how a donor advised fund can be helpful in specific circumstances. Again, as always, we're not tax professionals and don't take this as tax advice for your specific situation. But if you have questions, reach out to your CPA. Feel free to get in contact with us. We would love to have a conversation with you. If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.